Okay, day 16, section 3. Let's talk a little bit about the history of the international monetary system and how central banks have managed exchange rates. And that will kind of then transition us into talking about how the international monetary system and exchange rates work today. So, really, before World War II, most countries were on the gold standard, right? And so, what did the gold standard mean? Well, the gold standard was a system of fixed exchange rates, right? It was a system of fixed exchange rates. So, under the gold standard, if $1 was equal to 1/20th of an ounce of gold and 1 pound was equal to 1/4 of an ounce of gold, you can do a little bit of algebra here and figure out that $1 was going to be equal to 5 pounds, right? So, in other words, the fixing to if everybody fixed to gold, it also meant that everybody was fixed to everybody else in terms of their currency, right? The gold standard, though, was really a very, very unstable, inflexible, and quite frankly, disastrous system, right? First off, under the gold standard, no country could control their money supply, control their inflation rates, their interest rates, their output, use stabilization policy. Basically, your money supply just went up and down based on how many gold rocks you had in the country at the time, right? So if they discovered gold in South Africa, money supply across the world would go up. If there were no discoveries, money supply across the world will go down, right? You had no control over your money supply. Interest rates were all over. This led to a lot of financial instability. It led to regular bank crises. It was difficult to use the money supply to control stabilization policy, right? So it led to a lot of macro volatility, right? It also led to a lot of what economists call beggar your neighbor policies, right? So let's say that you had a crisis. What were you supposed to do? Well, during a crisis, it's possible that gold would leave your country if people got freaked out. They're worried about you being able to stay on the gold standard. So what were you forced to do? You're forced to raise interest rates and try to keep gold in your country, try to keep all that capital in your country. But of course, we know today that raising interest rates during a crisis is only going to make the crisis worse, right? Or countries could drop off the gold standard, which they did quite regularly during World War I and during the Great Depression. But of course, the thought of even dropping off the gold standard could trigger panic. And so it was just a very, very inflexible, volatile system that honestly, it just didn't work, right? It just did not work. Which is amazing when you consider that there's still people out there who think we should go back to the gold standard. It's a historically stupid idea, right? Quite honestly, it's a historically stupid idea. So what happened after World War II? Well, after World War II, international trade collapsed. Everybody owed the US money because the US is largely the financier of the war. The US held most of the gold, and so it was really difficult to think about how to go back on the gold standard. Plus, I think most economists had a clear idea of the real limitations of the gold standard. And so there was a big meeting between all the major powers at Bretton Woods, Maine, right? And so they came up with what we now know as the Bretton Woods Agreement. And the Bretton Woods Agreement basically led to a fixed exchange rate regime where every country fixed to the dollar and then the dollar fixed to gold. This was designed by John Maynard Keynes, although he did not want the dollar to be the international currency. He actually wanted the International Monetary Fund to design a true international currency, right? That was not triggered to any specific country. But the US, because they had most of the economic power at the time, was able to kind of argue and cajole other countries and pressure other countries into using the dollar as the international currency. And so Bretton Woods really forced every country in the world to fix to the dollar. And supposedly the dollar was going to be then fixed to gold, though that didn't really happen. Bretton Woods also created the International Monetary Fund. The International Monetary Fund was created to help lending or provide lending for countries who are going short-term macro crises, right? So countries like the United States and Europe and other developed countries contribute money to the IMF. And the IMF uses this money to help aid countries that are having macro crises. It also created the World Bank, which is more focused on long-term lending for economic development and not so much on short-term crises, all right? So how do fixed exchange rates work, right? How do fixed exchange rates work? So let's think about how this happens. In reality, it's pretty simple, right? You can fix the price of anything as long as you stand ready to buy or sell at that price. And so what does a central bank have to do if they're going to fix their exchange rate? They have to buy or sell at that price, right? So let's think about a country, not the United States, right? But let's think about another country, right? We'll call this, for argument's sake, Canada. Canada wants to fix their exchange rate. What should they do? Well, let's think about two examples here. The first example is, how do they fix their exchange rate if their exchange rate becomes overvalued, right? What we mean by this is the Fed fixes the exchange rate, wants to keep their target at par here. Par would be the targeted exchange rate. But for whatever reason, the market says the exchange rate is down here at E1. So in other words, the exchange rate is overvalued, right? I agree, this terminology is a little confusing. Overvalued meaning the target is over what the market thinks the exchange rate should be. What does a central bank have to do when the exchange rate is overvalued? Well, the central bank has to try to put upward pressure on its exchange rate. It has to move this exchange rate up this direction. How's it going to do that? It has to increase the demand for its currency. And if you remember what we talked about at the beginning of the lecture today, how does the central bank increase the demand for their currency? They reduce the money supply by selling foreign reserves, right? They must reduce the money supply. That will drive up interest rates, okay? That will drive up interest rates, that will drive down expected inflation. They do that by selling foreign reserves. That will increase the demand for their currency and move the exchange rate up to their target, right? Why would a country want to keep an overvalued exchange rate? Well, the reason they would want to keep an overvalued exchange rate might be because they want to keep imports cheap, right? Many countries have tried to keep their imports cheap, meaning keep their exchange rate at a high value, because it allows them to buy things from abroad more cheaply. So for particularly countries that are very highly reliant on energy, right? Gas and oil, having an overvalued exchange rate allows you to buy those things very cheap. But there's a danger of doing this. And the danger is you can't sell foreign reserves forever. And the reason is you don't have an unlimited amount of foreign reserves. What happens if you run out of foreign reserves? Well, if you run out of foreign reserves, you're never going to be able to defend your target. And more than that, if the market thinks you can't defend your target, they're going to start pulling money out of your country really fast. And that's only going to increase the difficulty of you being able to defend your target. And so the danger here is a currency crisis, and that is what a currency crisis is. When markets lose confidence that you can keep your exchange rate pegged or fixed at the level you say it's going to be. When markets begin to worry about this, they say, I don't want to be the last person to pull my money out of the country before they reduce their exchange rate. I want to be the first person, because once that exchange rate goes down, my investments in that country are going to be worth less. But just like with the banking crisis, if everybody tries to pull their money out first, this can basically lead to a self-fulfilling crisis, right? If everybody gets freaked out and everybody starts pulling their money out, then what's going to happen to the foreign reserves of the central bank? They're going to drop, and you have a currency crisis, right? Meaning that the central bank has to accept a big devaluation of the currency. And often this will lead to a financial crisis because it will ruin the financial position of banks. It will mean that investors take huge losses in wealth as your currency depreciates. So this can be very, very costly. Having overvalued exchange rates can lead to a currency crisis. The flip side is, what happens if you keep your exchange rate undervalued, right? So this is the opposite case. Here you're trying to push your currency down, push the price of your currency down. So here we have the par exchange rate, all right, or your target exchange rate. And the market says, no, your exchange rate should be up above. Now what you're trying to do is you're trying to depreciate your currency. How should you do that? By increasing the money supply and buying foreign reserves. What happens when you increase the money supply? This will reduce interest rates. This will increase expected inflation, and that will put downward pressure on the demand for your currency. The downward pressure and the demand for your currency will reduce the exchange rate. Why would a country want to keep their exchange rate undervalued? Well, here, this will help keep your exports cheap. So if a country like China, who has done this often in the past, is really focusing on promoting exports, right? They view exports as the way, their foundation to economic development. One way to keep your exports cheap is to undervalue your currency, to try to push your currency down. But of course, once again, like everything else in economics, that leads to a cost. One of the costs is you're always going to be increasing the money supply. It's going to lead to inflation, right? And so this is going to be a problem. You also have the danger that with all this inflation, you could still have a currency crisis. You could still have investors flee your country. So oftentimes what countries do, like China, is they impose a lot of capital controls, meaning they impose limits on the amount of money that can come out of the country. They put all sorts of limits so that capital cannot leave the country very easily. Of course, you know, as is pretty obvious, if investors don't think they can pull their money out of a country, then investors may not want to put their money in there in the first place. And that's definitely true about China, right? Is that, as we're going to talk about here in a minute, China has an extensive system of capital controls that is aimed at preventing capital flight and giving the Chinese government a lot of control over the capital that's coming into the country and going out of the country. But of course, what it means is that not very much capital actually goes in, because many investors don't want to take the risk of not being able to control their capital once they put it in China, right? So as we've been talking about here, China has traditionally maintained an undervalued exchange rate, though they're doing this less than they have before. Most economists think this is kind of playing with fire, right? Because it's creating a situation where you have building inflation, and you're also putting severe limits because of these capital controls, putting severe limits on the amount of foreign capital that you can attract, which can really limit growth. What happened during Bretton Woods? Why did the Bretton Woods system fall apart, where every country fixed to the dollar? Well, basically this fell apart because the US didn't play by the rules. This only was going to work as long as the Fed kept the dollar very stable, right? But in the 1960s, the US was fighting the Vietnam War. They were spending money. Inflation began to rise in the US. That meant that every country would have had to see their exchange rate change with the dollar. But that didn't happen. And so as a result, the dollar went up, the dollar went down because of inflation. That pushed every country in the world up, meaning every country in the world had an undervalued exchange rate. They found themselves in this situation. But not every country wanted that. They didn't want to have to increase inflation along with the United States. The US saw trade deficits rise, and every other country saw the US saw their trade balance rise. So in other words, the US started to run a trade surplus, and every other country began to run a trade deficit. They didn't want to do that, right? Maybe just the easier way to explain this is, As the US began to change its monetary policy, not every country wanted to do the same thing as the United States. Not every country wanted to just play follow the leader with the United States. And so eventually countries began to drop off and they began to fix independently, right? They said, well, sure, we'll fix to the dollar, but we're going to choose our own target to fix at. Or they said, no, I'm going to fix to another currency. Or they decided to float. And by floating, you mean just let the market decide what the exchange rate should be. The US dropped officially off the gold standard in 1971, and the Bretton Woods system was officially over. So what that means is today, every country for themselves can kind of decide what they want to do. They can fix, right, to a currency, the dollar or another currency. They can float, letting the market determine, what the exchange rate is, or they can do some sort of hybrid approach, meaning they can do a little bit of both. So in the last section of today's lecture, I want to kind of come back and talk about, the modern international financial system and some of the things that central banks have to think about when they set exchange rate policy.